Good evening, everyone. Welcome you all to this institute's cost of capital in the subject of financial management. Uh, Last class, we have learned about the ratio. We have quickly revised the ratio analysis topic. And today, our agenda is going to be the cost of capital. Okay. I'm pretty sure you might have revised the things about the ratio topic. We have done a few questions, one question and one question I've given the homework. I will expect all of you to be solving it because only after that I will be probably in a day or two I'll be uploading the solution for the second question. So today our topic is cost of capital. Without wasting much of our time, let's get started immediately with this topic of it is interesting topic and also quite sometimes challenging. Some of the questions quite be maybe sometimes challenging in exam. So let's get started with cost of capital. The flow of our today's session is going to be a combination of questions and concepts. Questions will be obviously to understand the concepts together, and we'll have two questions available. I have shortlisted two questions. One, I'll try to solve both of them in our today's session itself, so that you know to cover decent amount of variety of questions. Okay, let's get started. I can see few participants have already joined the meeting room, and let me just check the status of the portal. Good evening. Okay, few of you have also joined on the portal. Fine, great. So let's get started guys, without wasting much of our time. Targeting the topic of cost of capital. Okay, now, cost of capital. Uh, Before we go into what this concept is, we need to understand what is the function of a typical business. Any business entity, the basic function that it performs is getting money from the market from its various stakeholders, right? The stakeholders can include its shareholders, bankers, debenture holders, right? So you have like sources of funds, and then these funds are basically employed by that business entity into its operations. That's the basic fundamental application or fundamental thing that a typical business does. So it raises funds from its stakeholders and applies or invests those funds into its operations. Right now, in this activity, on one side you have providers of the fund, and on the other side you have business or you have the operations wherein you are putting the money, you're investing the money, and you're able to generate some sort of returns. Now, obviously, when you are raising money from one of the sources, maybe your shareholder, it may be your debenture holder, maybe your bank, the business entity is not going to receive money free of cost, right? It is going to be having some amount of uh, cost involved in it, right? So when you're raising money from the market, there will be costs that you need to bear. And of course, when you invest the money into the operations of the business, you are going to generate returns out of it. All right. So in business, you have on one side, which you have the sources of funds. On those sources of funds, you need to pay certain amount of cost. And on the other side, we are going to invest our money on which we are going to generate returns. Our agenda for today is to understand this aspect of the business as to wherever you are, from whatever sources we are able to get the money, what is the cost of the funds that we are raising from the market? Those costs of funds will vary according to the type of funds that we are generating, right, or type of funds that we are raising. If I ask you what are the various sources from where you can raise money, can I get some answers from you? Can you name few sources of money? Yes, participants. Can you just tell me what are the sources of funds that you can think of? What are the sources from where a business entity can raise money? Okay, so I have the answers coming in as equity shares, fine. Then, okay, debentures, okay. Then we have money coming in from banks. Okay, okay. Someone is saying bonds, okay, debentures or bonds. You can, as of now, you can use them interchangeably. They are not safe. We'll discuss about that sometime later, but you can say that it's both of them are remaining safe. Then equity shares, debentures or bonds, banks, or you can also have it from the preference shares. Perfect. We have it from the preference shares. So these are the sources of funds where from where you're going to get the money for your business. Now, in what proportion we are going to raise the money? What will be the proportion of equity share? What is the proportion of debentures or banks or preference shares? That's a later point of discussion. Right now, our focus is whatever are these sources of funds. We want to know what is the cost of those funds. But remember, no one is going to give you money free of cost, right? No one is going to give you, someone giving you money in your hand that you just take it away unless and until you get it as a gift from someone. But for business purpose, if you're raising money, of course, you are expected to bear certain costs. Our objective in this chapter of today's discussion is to uh, understand what is the cost of capital. How do we compute the cost of various sources of funds that we are raising? Okay, we are going to see how to get the cost of the equity shares that we are raising, how to get the cost of debentures that we are raising, how to get the cost of preferences that we are raising, how to get the cost of retained earnings or reserves that we have. Okay. So that's our agenda. We are going to understand the cost. Now the question is, why are we really interested in computing the cost of funds? Why should we be really interested in knowing what is the cost of our funds? Because understand, cost is going to be definitely a criteria to decide where you are going to invest your. Like for example, if you are raising money from the market at a cost of let's say 10%, for example, what should be the rate of return which you will expect from your investment into the operations or investment into your into the projects that you are undertaking? What will be the rate of return that you would expect? Tell me. Bhumika, Jayalakshmi, Manish, Vidushi, Yugandhar, tell me. If my funds are costing me 10%, if I have got money from someone from the market at a rate of 10%, if I'm supposed to pay them 10% return, what should be the rate of return that I should be expecting from the operations or from the projects? What should be the rate of return that I should be expecting? More than 10, right? Exactly. The rate of return has to be more than 10, otherwise it doesn't make sense as why should I do business, right? So the primary focus of calculating the cost of capital is to know what is the rate bare minimum I should be getting from my investment. Because any investment that is going to give me less than my cost, I'm not going to do that investment. I'm not going to invest my money in those areas. All right. So, of course, here we mean that the primary purpose to calculate cost of capital is to know which project should I be interested or which project should I be taking up for the purpose of the investment. Let's get started with computation of cost. Now, when we are looking at cost of capital, just keep in mind cost of capital is basically what is the rate of return that our investors acquire when I'm raising money from. Okay, so cost of capital is it is like what is the rate of return that my investors require against the money which they have. Cost is basically not the amount which the company plans to pay or actually pays. Rather, it is the expectation of the shareholders. So, cost of capital is the percentage per annum return expected by the stakeholders. Now, what do we mean by stakeholders over here? Of course, stakeholders simply mean guys persons who have given you the money. It can be your debenture holder, it can be your preference shareholders, it can be the equity shareholders, or it can be the bank. Because remember, unless and until you are fulfilling their expectation, they are not going to provide you funds. Correct? So you need to provide them return as per their expectation, then only they are going to provide you funds. If you're not going to ready, if you're not ready to pay them return, or if you're not going to provide them return as per their expectation, they will definitely not be interested in investing your business. Remember, cost of capital is basically the percentage per annum return which is expected by the stakeholder. Okay. Now, how do we compute what is the percentage per annum return expected by the shareholders or by the stakeholders? For that purpose, let's take it up one by one. Like first one, let's take cost of debt, and it's denoted as KD. Okay, can you guys just tell me one distinction between debt and owned funds? Can you tell me what's the difference between debt and owned funds? Any one feature, wherein you can simply say that if this is the feature, then we say that it's a debt, and if this is the feature, then we say that it's equity. Can you tell me what will be that one single feature which distinguishes debt from the equity? Yeah. So remember, guys, in case of debt, there is always an obligation on the entity to repay the capital or to pay some fixed amount of interest or pay a promised amount of interest to the fund providers. There is always an obligation on you to pay certain amount back to the investor. Now we say cost of debt. How do we get this cost of debt? Let's understand certain features of debentures we need uh, to understand before we go about calculating the cost of debt. First of all, whenever we talk of debt, primarily we're taking an example of debenture. In debenture, we have something called as face value. This is basically the nominal value which is used, basically a nominal value which is used to face value is the nominal value which is used to calculate interest payments. It is used to calculate interest payments, right? And then we have interest, or what we call it as coupon also. Okay, so interest or coupon rate, that rate will be given to you. That rate multiplied by face value is going to give you the amount of interest. Right? So if a typical company is issuing debentures, let's say at a face value of 1,000, and it has promised the coupon rate as let's say 10%. Of course, that 10% multiplied by 1,000 will be the amount of interest that the company is going to pay every year as a coupon payment to its debenture holders. Okay. So In case of debentures, as I said, there is always an obligation to pay back the money or to pay back the interest at regular intervals. So, of course, when we have that obligation to pay back the money, the question arises, when are we supposed to pay back that? So, when are we supposed to pay back the money? First of all, we need to look at redemption value. One is the redemption value, and other is the maturity. So maturity period is basically the time period for which the investment is made by the investor. It's going to be a fixed maturity period. And redemption value is the value at which the bond will be redeemed. Generally, it is the face value, but sometimes it may be also at a premium or at a discount. Okay, fine. Then one more important aspect that we have in case of venture is something called as tax shield. Tax shield, or we call it as tax benefit of interest payment. We have tax shield or tax benefit of interest payment. Okay. Tax shield or tax benefit of interest payment. Let's understand this concept simply. Let us say uh, you are going to issue a venture. Issue price is, let's say, 105, and it has got a face value of suppose 100 rupees. And the question says that there is a coupon rate. There's a coupon rate of, let's say, 10%. The coupon rate is 10%. Can you tell me what will be the interest amount? Interest amount will be definitely 100 rupee face value into 10%, which is 10 rupees, right? Now, if I ask you, what is the cost of debt over here? The cost of debt. See, cost of debt is as simple as calculating your rate of interest. Over here, you're receiving 105, and on that 105, you're supposed to pay 10 rupees. On 105, you're supposed to be paying 10 rupees. So if I multiply it by 100, that cost comes out to be, so that's 10 divided by 105 is 9.52%. The cost comes out to be 9.52%. But remember, in case of debt, in case of debt, uh, this is not my actual cost. My cost is lower than, because in debt we have something called as the tax shield or tax benefit on interest. Let's understand that quickly. Suppose without debt and with debt, let us take two scenarios: without debt and with debt. We have earnings before interest and tax. Over here, let's say it is 1,000. Of course, we are going to subtract the interest only in case of with debt scenario. We're going to subtract interest only in case of with debt scenario. So let's say interest payment is suppose 100 rupees, and without debt, of course, there is no interest. So we get the profit before tax to be 1,000, and with debt, the profit before tax comes out to be 900. From that, we are going to reduce the tax. Let's say tax at the rate of 40%, or 30% is generally accepted term. 300 is the amount of debt. Sorry, that's the amount of tax. And when you have debt, you're supposed to be paying 270 as interest. Now, of course, you after you subtract that, you get the PAT. Okay. So PAT works out to be 700, and with that, the PAT is was 630. If I ask you, what is the interest expense? Interest expense is 100 rupees, because you observe that interest over here is charged as 100. But wait a minute, just have a look at the PAT figure. By what amount has the PAT reduced? By what amount has the PAT reduced? PAT has reduced by just 70. Am I right? PAT has been reduced by just 70. So tell me, what is your actual cost of interest payment over here? Is it 100 rupee or is it 70 rupee? Because the profit has reduced by just 30. Of course, the answer is 70. Of course, the answer is 70 because your profit has reduced by 70. Why not 100? Why not 100? Because you see, 100 is the interest expense. Okay. 100 is the interest expense. But one notable fact is there is a tax saving of 30, and that gives you a net, cost of 70. So whenever we have cost of debt, we are going to consider this tax shield. Whenever we have cost of debt, we are going to definitely consider this tax shield. And cost for me over here, my cost of debt, it's going to be 10, but we have to give the tax benefit out of it. So 10 into 1 minus zero point 0.3 is the 30% tax reduction, right? And then you divide it by 105 into. Always remember, whenever there is a debt, uh, cost of debt, whenever we are computing, we are going to give the impact of this tax rate. Okay. So now let's go for quickly looking at the cost of debt formula. Well, the cost of debt formula is simply what we have demonstrated right now. It is interest into 1 minus T upon net proceeds into 100. Okay, so that's interest into 1 minus T net proceeds upon net proceeds into 100, converted in percentage. Well, the net proceeds is what you are going to get in your hand. Okay, so net proceeds is realization from issue of debenture or from issue of debt. Net proceeds is the amount that you realize when you are going to issue the debt. How is it going to be different from the face value? Face value is basically the amount on which you're going to receive the interest. That need not be the amount that you're going to receive. Okay. So net proceeds, when we say, it is going to be issue price minus the flotation cost. Again, the issue price can be at a premium, it can be at a discount, and the flotation cost may be separately given. Okay. Or sometimes this net proceeds will be same as market price. Okay, fine. This makes sense, guys. So remember, in the denominator, this net proceeds will be realization from the issue of the debt, and or it can be issue price minus the flotation cost if they have given us, and it can be even the market. But remember, this formula is applicable only in case of when we are going to compute cost of irredeemable debt. You can compute cost of debt using this formula only if it is the case of irredeemable debt. So there will be different formula, of course, for redeemable debt also, right? So cost of redeemable debt. What do you mean by redeemable debt? Redeemable debt means you are going to repay the debt with certainty after certain number of. Irredeemable debt means you're not going to return back the principal, rather you're just going to continue paying interest on a regular basis. You're going to pay the interest on a regular basis, and in case of redeemable debt, you're going to pay it in certain period of years. So let us say, let's take an example to get this formula and to understand it in more detail. Let's say face value is 1,000 rupees. Face value of the debenture is 1,000 rupees. Coupon rate is 10%. The term for which the debentures are issued, let us say it is 5 years. Tax rate applicable is 30%. And we are issuing this debenture at a price of, let's say, 990. So we are basically issuing the debenture at a discount. Okay? And let's say redemption value, we are going to redeem this debenture at a price of 1040, 1040. So in this case, I want to know what is the cost. What's the cost for me when you're going to issue the debenture? Now, of course, as I stated, cost is always going to be expressed in terms of percentage per annum. Cost always has to be expressed in terms of percentage per annum. Percentage is a separate thing. First, if I ask you, what is the per annum cost? Per annum cost in terms of rupees. Let us take per annum cost in terms of rupees. What is the percentage? What is the per annum cost in terms of rupees? Of course, this cost is going to comprise of two things. One is the interest cost plus we are going to issue the debentures at 990 and we are going to get it redeemed at 104. It means we are getting a lesser amount, and when it comes to repayment, we are paying a higher amount. Right? When we are receiving 990, but we are paying out 1040. Of course, in that situation, we will definitely say that the that's also a cost for it, right? Or let me just take it as capital cost or redemption cost basically. So in terms of per annum cost, interest will be definitely 10% of 1,000. This will be definitely 10% of 1,000. But remember, we are going to give a after tax effect. So I'm going to make it as 1 minus 0.3 plus. What is the redemption cost that we have? Redemption cost is basically 1040 minus 99. 50 is the cost that I'm bearing, right? 50 is the cost that I'm bearing for this debenture for a period of total 5 years, right? For a total period of 5 years. But remember, 50 is the cost for full 5 years. So can you tell me what will be the cost every year? I need to just divide it by 5, correct? Right? So this is like 100 into 1 minus 0.3 plus 1040 minus 990 upon 5. If I ask you, what is the percentage per annum in terms of per annum cost, first of all, in terms of formula, that's going to be interest into 1 minus t plus redemption value minus net proceeds by number. Now, if I want to calculate percentage per annum cost, of course, this numerator, interest 1 minus t plus redemption value minus net proceeds by n, this entire thing has to be divided by some principal amount. This has to be divided by certain principal amount. So what will be that principal amount? See, we got 990 and we are going to make repayment of 1040. So our principal outstanding is slowly growing from 990 to 1040 over a period of 5 years. Right? So it's growing from 990 to 1040 over a period of 5 years. So I cannot say that my principal is 990. That may be 990 for the first year, but then it increased by a certain amount to second year, then it increased a certain amount to third year, then it increased by a certain amount to fourth year, and then finally up to the fifth year, it becomes a maturity value of 1040, right? So instead of taking either redemption value or either net proceeds, we give equal justice to both the value, which is the starting principal value and the ending principal value. And we take it as redemption value plus net proceeds by 2, take an account of average principal outstanding. This is like an average amount of principal outstanding is what is considered over here and percentage per annum. Okay, and of course, we just multiply it by 100 to get the get the what do you say amount of percentage per annum. Okay, so that's the first part where we are looking at the cost of debt. Cost of debt is computed as percentage per annum cost is interest 1 minus value minus net percent divided by n. Let's go to the another cost of capital, which is about let's say preference share. Remember the characteristic of preference share and that of debenture are similar because there there is a fixed amount of preference dividend that is paid. There is a redemption value. There is a net proceeds or there is a payment that happens. So cost of preference share is also on similar line. Cost of preference share. Again, there we have two categories. One is if it is irredeemable, if the preference shares are irredeemable, then we say that cost of preference share is preference dividend upon the net proceeds into 100, of course, to make it a percentage. And second case, if it is redeemable debenture, redeemable preference share, then the formula is similar to the cost of debt itself. It is preference dividend plus redemption value minus net proceeds upon n, the whole divided by redemption value plus net proceeds by 2. Now remember one peculiar characteristic of preference share as compared to the debt, you don't have any amount of tax savings on preference. Because preference shares are basically payment to your own, own fund providers. So therefore, you don't get any tax benefit. Preference dividend payment happens only after payment of tax. So there is no tax benefit that you receive in case of preference share. Okay. Is it clear till now, everyone? Are we clear? We've done cost of debt, we've done cost of preference share, and these two methods are approximation method. These are the approximation method, a simpler way of calculating the cost of preference shares and the debt. The real cost of debt needs to be computed in a bit different manner using something called as yield to maturity. Okay, that we are going to discuss, probably after we are done with all the basic formulae for cost of debt, cost of preference share. After that, we will also cost of equity we are going to cover. After that, we are going to look into the detailed method of IRR method or YTM method of computing the cost of debt. Now, let's go for another source of fund whose cost is really relevant for us. That's called as the cost of equity. Now, legally speaking, the company is under no obligation to pay any amount to the equity shareholder by way of dividend or by way of any sort of repayment. There's no such obligation on The companies know as per their decision in the board of directors, they can propose dividend. Shareholders have no right to ask for dividend or to raise the amount of dividend. Shareholders have the right to reduce the amount of dividend. But then, does that mean no equity has got no cost because there's no obligation on the company? It's not like in case of equity shares, we need to understand what are the expectation of our shareholders. If our shareholders are expecting something, that is something we need to generate a return for. So understanding the expectation of equity shareholders is a very difficult task, and therefore you have hundreds of different models, which try to understand what are the expectation of the equity shareholders. It is quite known thing that uh, if you are getting money from banks, the bankers generally tell you, what is the rate of return they require. But if you're getting money from someone who is, like your parents or like your brother or sister, so then they don't tell you, they don't explicitly say what is the return that they need. They will definitely be expecting something more from you, more than what the banker requires. Right? Over here, equity shareholders are definitely undertaking a higher risk because they are entitled to the residual income. They are not entitled to they don't have a preference over the distribution of income. They are the persons who are going to receive the money at the end. Therefore, the risk is higher and their expectation is something that we need to understand. There are different approaches to understand the expectation of shareholders. One approach is constant dividend approach. So, first approach is constant dividend model. Uh, Let me see how many of you can guess it easily. The company observes certain pattern in its share price and the amount of dividend. Okay, let's have a look at it. So we've got dividend and we've got the market price of it. When company declared a dividend of 7 rupees per share, then the market price was 77. Next year, when company declared a dividend of 9 rupees, the price became 99, around 90. When company, then let's say COVID struck and the company's earnings went for a fall and company declared a dividend of just 3 rupees. At that time, the share price is 30. Again, there's a bounce back and company declared a dividend of 11. And at that time, let's say the share price is turning around, let's say 120. Now, can you tell me what is the return what is the amount of dividend that the company expects, that the shareholders expect from the company? Can you tell me what is the cost of equity over here? Because cost of equity, as I said, cost is basically what are the expectation of our stakeholders. So expectation of our stakeholders is what we are interested in knowing. Every time you observe over here that your dividend is dictating the market price. So if this is the approach that is observed in the market, we find that K is basically, you observe 7 divided by 77, 9 divided by 99. All these percentages, you'll find they are equating to 9.09. So one of the approach of computing the cost of equity is you're assuming that the company is going to give some dividend, based on that the market price is going to be there. And remember, equity shareholders never speak by words. Equity shareholders are going to never speak by words. Rather, they are always going to speak by their actions. Actions in the form of they're going to explain the actions in the form of share price. Okay. See, when the company declared a dividend of 9, there was a buying happening in the market. There was a buying happening in the market, and that pushed the share price from 77 to 90. When the company reduced the amount of dividend, the shareholders' expectation was not met, and their action was selling the shares. So they started selling the shares, and the price dropped to 30. Again, when you are declaring good dividend, there is a buying pressure on the company price, on the company shares, and again the price. So the expectation is something understood by way of action, and over here, the cost of equity is going to be computed as dividend upon P0 is the dividend that is expected from the company, right? And the price that you observe. That's dividend upon current market. Sometimes, equity shareholders, they understand that company need not give dividend. Company will retain some amount of dividend for the purpose of reinvestment purpose. So in that situation, another way of understanding the shareholder's expectation is to track not dividend per share and market price per share, but rather track the earnings per share and the market price per share. So the second model is constant earnings model. Second model that we say is the constant earnings model, wherein instead of market price, instead of assuming that market price is dependent on the dividend, say market price is dependent on the earnings of the company. So here we say cost of equity is dividend amount divided by cost of equity equal to the amount of earnings that is expected on on current market. So it's like earnings yield we have learned in the ratio analysis works. That is earnings upon the price. That's the expectation of the shareholders that the company needs to fulfill. Okay. But going ahead, shareholders, as I say, they are definitely going to expect higher and higher returns from a company. You cannot assume that company is going to give me the same amount of earnings throughout its life. Company is going to give me the same amount of dividend throughout its life. So no company would be earning the same amount as it used to earn 10 years before. The numbers would have definitely increased. Why increase? Because the sales are growing, the customer size is increasing, the return to the equity shareholders is increasing. So in that scenario, we should be looking at basically cost of equity with growth perspective. Cost of equity with growth perspective. So here the cost of equity is computed as E1 upon P0 plus growth. Cost of equity is basically D1, which is the upcoming year dividend, the expected dividend. P0 is the current market price, and G is the growth rate at which your money is going to grow. And this approach is called as constant dividend growth. Is constant dividend growth model. Okay. Constant dividend growth model. We say cost of equity will be P1 upon P0 plus growth rate. This is basically what is the expected dividend in the upcoming year plus the growth. Now we get this P1 figure. If you don't have what is the expected dividend in next year, you will definitely know what is the dividend that you have paid recently. Just add the growth factor to it. Is multiplied with 1 plus. Okay. Now sometimes this P0, you can also take it as net proceeds if the question is giving you some sort of information that current market price is so and the flotation cost involved will be. Okay. More about this dividend growth model, we will be learning in the chapter of dividend decision, the Gordon model. Okay. We learn about this constant dividend growth model, the chapter of dividend decisions, how this formula has been derived. We'll learn it over there. Okay. Then the question arises, sir, how do you know what will be the growth rate? How do you know what will be the growth rate? Well, this growth rate can be computed by two approaches. One is based on past data, and another is based on retained earnings. Now, how do you know what will be the growth from the past data? Let us say, if I tell you, in the first year, the dividend that was paid was rupees 5. When we went to second year, the dividend that was paid is, let's say, 5.6. Then in third year, the dividend amount was 6.27. Then in fourth year, the dividend amount is 7.02. And then in the fifth year, you observe that the dividend is 7.87. Now, can you tell me uh, this pattern of dividend amount, the amount of dividend, right? Can you tell me what is the growth rate in dividend by mere observation? Just observe and tell me what is the growth rate in dividend that's happening. Can you tell me what's the growth rate in dividend? Perfect. It is 12%. Correct. So here, by observation, you can say that growth is 12%. But sometimes the growth may not be exactly visible that it is 12%. Sometimes it may be haphazard manner also. So the ideal way to get the amount of growth rate, if I tell you, dividend in year n will be dividend in year 0 into 1 plus g raised to n. Remember this formula, guys? Dn equal to d0 into something similar. I think you might have learned this in we say in time value of money, compound interest, right? That I've learned it in compound interest, right? So that's a simple formula. So if you just apply this formula over here, where let's say d5, apply the formula over here, say yeah, d5 equal to a0 into 1 plus growth raised to 5. D5 is 7.87. 7.87 is equal to 5 into 1 plus growth raised to 5. From here, you can just get 7.87 divided by 5 is 1.574 equal to 1 plus growth raised to 5. You say you will be able to get growth rate, right? So that's how you compute the growth rate based on the past data, based on the historical. Another way to compute the growth rate is to look for retained earnings. So retained earnings, using retained earnings, you can get the growth rate as B into R, where B is the retention ratio and R is the return on investment. Now see, the company can give growth in its dividend. Company can provide you growth in its dividend only and only if company can provide you growth in the dividend only and only if it is retaining your money, right? So whatever the money is retained, the company is going to invest it at some rate, and that is going to provide the growth to the shareholder, growth in the dividend to the shareholder. Okay, so that's the third model, which is constant dividend growth. Then the next formula or next approach to calculate the cost of equity is basically called as the CAPEX or the capital asset pricing. have capital, asset, pricing, model. Second, here we don't look at what is happening in the share price of the company. This model actually gives you what is the return required of shareholder, required return of the shareholder. So that's simply computed as K equal to RF plus beta into RM minus RF. Risk-free return plus beta into RM minus RF. Now, RF is basically risk-free return, the bare minimum rate of return which you can invest by investing in government security. RM is the rate of return on the entire market portfolio. Like you have Nifty or you have Sensex, which are the index numbers of all the major companies. So on an average, what's the market return? That's your RF. And beta is a measure of systematic. Right? So for example, if beta is let's say 2, beta is let's say 2, what does that imply? Beta of 2 simply implies if market return increases by 1%, or if market return increases by 1%, shareholder return should increase by 2%. If market return increases by 1%, shareholder return should increase by 2%. Right? Or it can be also stated as equity shares of company are twice risky as equity shares of company are twice risky as market. So of course, if the equity shares are having double risk as compared to the market, the equity shares have double risk as compared to the market. The return that you expect, the risk premium that you expect will be also double. So that's a systematic risk which we observe in this KPM. Okay. Then another source of capital that the company has, uh, that your retained earnings or the reserve, retained earnings or the reserve. Now, remember, cost of reserve or cost of retained earnings is going to be same as cost of equity, because retained earnings are ultimately whose money? Retained earnings are ultimately the money of the equity shareholders. So equity shareholders, whatever they would be expecting on their equity share, of course they would be expecting a similar rate of return on their retained earnings, right? So remember, cost of retained earnings is going to be same as cost of. We have got to understand how to calculate the cost of debt, how to calculate cost of preference share, how to calculate the cost of equity, and also cost of retained earnings. Now, as a business entity, you're not going to be functioning with just one or two types of funds. You will be obviously raising money from multiple sources. You'll be getting money from equity shareholders, you'll be getting money from the debenture holders. So you are going to have a pool of capital coming from multiple sources. I want to know that I will be investing that pool of money into some project. So I want to know what project should be giving me return. I cannot be just looking at one single type of cost of capital. I need to compute overall cost of capital, or what we call it as weighted average cost of capital. So weighted average cost of capital. Now let's understand this with the help of an example. You have got equity as one source. You have got preferential capital. You have got debt, right? Let's say we have also got along with equity. What's the reserves? Then we have got debt and let's say preferential. So you computed cost using the models that we have learned right now. Let's say equity has got a cost of 15%. Same goes with the reserves also. Let's say debt is having a cost of 10%, preference share capital is having a cost of 12%. I want to know average cost of my fund. I cannot take a simple average because the amount of equity, amount of debenture, each one of them is different. So I need to consider an amount. Now this amount, it can be the book value or it can also be the market value of these securities. If these sources of funds, that is equity share, debentures, and preference shares are listed in the market, they will be considered the market value. Amount can be book value, right? The book value is, let's say, we have got 1 crore of equity, 60 lakhs of reserves, 40 lakhs of, let's say, debt, and preference share capital is 90 lakhs. The total capital, so preference share capital, 50 lakhs. Total capital that we have invested is 2 crore 50 lakhs. Over here, we need to compute the weightage. Out of 2 crore 50 lakh, 1 crore is equity. Out of 2 crore 50 lakh, 1 crore is equity. If that's the case, what is the weightage that we have? Weightage is basically zero point 0.4. How do you get the weightage? That's 1 crore divided by 2 crore. And then for 60 lakh, the weightage is 60 divided by 250. That's working out to 0.24 as a weightage. And with regards to 40, say it is 0.16. And then 50 divided by 250, that will be 0.20 as the weight. If you want to get the weighted average cost, I just need to multiply weights with the cost and simply take a total. Weights multiplied with the cost, 15% into zero point 0.4. Zero point 0.4 into 15%, that will be 6%. Then 15% into 0.4, 0.6. Then 10% into 0.16, and then this is point. Take a total plus 3.6 plus 1.6 plus 2.4. It all works out to be 13 point. Weights into cost is 13.6%, or we say it is our overall cost of capital, or what we call it as weighted average cost of capital. Instead of book value, if the question asks you to compute the weighted average on the basis of market value, you are supposed to be taking the market value in this. But remember, one important point, in case the question is asking you the market value, you are definitely not going to consider the reserves in the calculation because there is no separate market value for the reserves. Rather, the value of equity uh, and rather the value of equity and reserves are all combined in both cases. You get the market value of equity share as a combined market value of equity and the reserve. Okay, very good till now, everyone. Yes. All good? Okay. That's about this weighted average cost of capital. Now, as we have discussed, we are going to discuss about um, the cost of debt that YTM method or yield to maturity, cost of debt in YTM or yield to maturity method. Let's have a look at it. Cost of debt using YTM method. Cost of debt using the YTM method. Now, if I ask you simply, let's say the principal is 1 lakh and the repayment amount that happens is 1 lakh 21,000 after a period of, let's say, 2 years. Can you calculate and give me what is the rate of interest, guys? Tell me. Please calculate the rate of interest over here. I tell you that 1 lakh is the principal, amount is 1 lakh 21,000, number of years is 2 years. Can you tell me what's the rate of interest? Yep, waiting for your answer, guys. Tell me what will be the rate of interest? Yeah, tell me, guys. The amount is 1 lakh 21 for a principal of 1 lakh for a period of 2 years. What is the rate of interest? You calculate and let me know what's the rate of interest. No, I'm not talking of simple interest. I'm talking of compound interest. Compound interest. Give the compounded effect. Give me the compounded interest values. Compound interest. You simply use the formula, right? A is equal to P into 1 plus I raised to N. So amount is 1 lakh 21,000. Principal is 1 lakh. And we know what is 1 plus I, so that's raised to 2. So that becomes 1.21 equal to 1 plus I raised to 2. Taking square roots on both sides, we say that it's 1.1 equal to 1 plus I, and I is basically 10%, correct? That's how you compute the value, right? That's how you compute the rate of interest. Perfect. Are we all good with this calculation? I'm pretty sure that you'll be aware about how these calculations are done because that's a very primitive way of solving it, right? Now, if I tell you that let's have a debenture, let's talk of a debenture with a face value of 1,000 is having a redemption value of, let's say, 1100. Interest is, let's say, rupees 90. Number of years is, let's say, 3 years. Okay. And we want to know what is the rate of return. So I can say, sir, this uh, the face value that you have received, which is 1000, like over here, we stated that A is equal to P into 1 plus I raised to N. That implies principal is nothing but amount divided by 1 plus I raised to N. Or you can say present value is whatever are the future values, whatever are the cash flows that you are going to get, that divided by 1 plus I raised to N. So here we say 1000 is equal to whatever 1000 is what you're receiving, right? And the interest payment that you have, right now we are ignoring the taxes for the sake. So interest is basically 90. So first year you're going to receive the 90. Take the 90 divided by 1 plus I, which is first year discounting, plus 90 that you receive in the second year discounting, plus 1190, that's 1 plus I raised to 3. Can you tell me how do we compute the I over here? Because whatever is I that we are going to receive, whatever is I that we are going to calculate, that's exactly the rate of return that an investor expects or the company is supposed to be giving. Right? So we want to know this I by solving this equation. But the fact is that I cannot solve this equation with pen and paper. I don't know how to solve this cubic equation. Not much of mathematics I'm getting involved with. I want to know what is this I value. Right? So how are we going to get this value of I? We are simply going to use something called as IRR method or YTM method, wherein for each of these cash flow, say year and cash flow. So in year one, or rather from year one till three, you're going to receive 90, and also in third year, you're going to receive 1100. We are going to write down the PV factors and PV. PV is basically present value factors. And when you multiply the cash flows with the present value factor, you receive the PV. And the total of this PV should be 1000 rupees. Because I want to know at what rate I am going to discount this cash flow so that the total PV is equal to 1000. So now I don't know what is the typical PV factor. What rate should I really be discounting? So one easier way to do that to start with is compute the approximate cost of debt. You can compute the approximate cost of debt simply by taking it as interest plus redemption value of 1100 minus face value of 1000, assuming that itself is the net proceeds, divided by 3, the whole upon 1100 plus 1000 divided by 2. So this will give you an approximate IRR or approximate YTM value, approximate cost of debt. Let's see what it is. 700 minus 1000 divided by 3 plus divided by, that works out to be 11.75%. This is the approximate value. The real value we are going to get it by interpolation or by this YTM. So let us take a present value factor at the rate of, since we have this as 11.75, let us consider to start with as 12%. Let's write down the PV factor for 12%, guys. PV factor for 12%. Can compute it on calculator by simply taking it as 1 divided by 1.12, right? And equating it 3 times. Equate it in my calculator. Rate is 12%. Number of years we have to equate it to times. Yeah. PV factor is yeah, that is 2.4018. And for the third year, we are getting it as, yeah, 0.7118. We get the PV factor at 12% at 2.40118, and this is 0.70118. And if we just multiply them, number that we get is, 90 multiplied by 2.4018 is 216.16. And then 1100 multiplied by 0.7118 is 782.98. So if I total it, that works out to be 999.14. It means I'm not getting the value of 1000, not receiving the value of 1000. So I want the present value to be 1000, present value to be equal to 1000. So I need to just, take a lower present value factor. If I reduce my present value factors, the rate, if I'm going to reduce, the PV factors will be higher and the value is also supposed to be higher. PV factor, we'll take it as, let's say, at 10% maybe, and then we take the PV. So at 10%, this is 0.7513, and the cumulative factor, this was going to be 2.486. Now, if we calculate the PV, that's going to be 90 multiplied by 2.489, which is 223.82, and then 1100 into 0.7513, that's 826.43. We just add them all, 223.82 plus 826.4. This works out to be 1050. What we have over here right now is, um, we want the IRR. So to calculate IRR, we have this formula: lower rate plus NPV at lower rate upon NPV at lower rate minus NPV at higher rate, right? Multiplied by,
जंग बंधु जी,
yes,
राजकुमार अडुकिया here. Hello,
yes, sir.
how are you?
All good, sir.
आप क्या सिखा रहे हैं जगबंधु जी?
Cost of capital, sir.
कौन से विषय में?
Sorry,
कौन से विषय में सिखा रहे हैं?
cost of debt, sir, using YTM method.
नहीं नहीं, विच इज द सब्जेक्ट
FMFM, financial management.
ऑफ इंटर?
Yes, yeah.
तो मुझे तो कुछ समझ में ही नहीं आ रहा है, क्या बता रहे हैं आप? मयंक, आप इसको देख रहे हो क्या?
Yes, sir.
मिस्टर मयंक, अजीत कौन है फैकल्टी? अजीत कुमार।
यस सर।
जगबंधु कैरी ऑन।
सर हेलो।
हाँ, कौन है? कौन बोल रहे
सर
हैं?
मयंक मयंक जी देख रहे हैं अभी।
तो मयंक किधर है? वो तो को होस्ट भी नहीं है, उन्होंने लिखा भी नहीं है कि वो बीओएस फैकल्टी है।
नहीं सर, सेन गुप्ता सर के साथ है वो, बेसिकली वही देखते हैं कॉस्टिंग और एफएम।
अरे मेरे भाई, मयंक जैन, आर यू देयर?
यस सर हैं। मैं उनको अनम्यूट करवा रहा हूँ बस।
नहीं, वो तो अभी को होस्ट हो गए, पहले को होस्ट भी नहीं थे।
यस सर।
हेलो। हेलो।
हेलो।
यस, गुड इवनिंग सर।
गुड इवनिंग मयंक, आपकी
हेलो
ड्यूटी बनती है कि आप को होस्ट बनो।
सर।
मैं जब
एक्चुअली
ज्वाइन
आई
कर
एम,
रहा हूँ
यस यस सर, आई एम
7:20
ट्रैवलिंग
पे,
सर,
आपको
आई एम ट्रैवलिंग
लीडर
टू
बनना पड़ेगा ना।
यस सर, एब्सोल्युटली सर। सर, आई एम
तो
ट्रैवलिंग टू
आप
माय
कहाँ बन
होम,
रहे हो
आई एम ऑन द
लीडर?
वे। सर, फॉर अ while आई एम ट्रैवलिंग टू माय होम, आई एम ऑन द वे। So this was the reason I am not the co-host.
लेकिन को होस्ट तो ऑन द वे से कोई संबंध नहीं है ना को होस्ट का।
Sir, how? Yeah, you are
चलो
right, sir.
जगबंधु कैरी ऑन।
Yes, yes. This IRR method, we first got it by using the approximate method 11.75%, but we want to know what's the exact rate of return that we are earning. And for that, we take the lower rate plus NPV at lower rate divided by the difference between the lower rate and higher rate, and then take the difference as lower rate and the higher rate. If we do that, the lower rate at which we computed the value is 12, sorry, it's at 10%. So we start with 10% plus NPV at lower rate was, you know, so NPV that we look at is the difference between the investment that we do and the rate of return that we are getting. So here NPV stands as 1,000 is your investment and you are receiving 999. So basically negative 0.86 is the NPV over here. And in this case, your NPV stands as 50.25 positive. Okay. We just apply this formula. We say the rate of return obviously has to be between 10% and 12%. The rate has to be between 10% and 12%. So we start with 10 and then add a multiple to it. So 10% plus NPV at lower rate, which is 50.25 upon the NPV at lower rate is 50.25 minus of minus 0.86 into uh, higher rate and the lower rate difference, which is simply 12% minus 10%. We're just interpolating between these two values, and by solving it, we get it as 50.25 divided by that comes out to be 11.96% on calculation. So that is our IRR or YTM method. That's our YRR or the YTM method, based on which we calculate the cost of debt. The cost of debt needs to be computed in this manner whenever the question asks for calculating using YTM method. So first you need to get the approximate cost of debt and then simply apply this formula. Okay, is this clear, guys? This IRR method clear to everyone? Issues, any queries in this? You can see if there are any queries. Again. Okay, why lower rate? No, lower rate is 10%. Because 10% is the lower rate and 12 is the higher. There was a swap thing over here. So it will be higher rate minus the lower rate value. Yeah. Okay. So let's do one thing. Let's take up one more in this case. Suppose we have a debenture, we have a face value of, let's say, 100, and number of years is, let's say, 2, and the redemption value is, suppose, 120. Coupon rate is 12%. Now over here, if I ask you what is the approximate cost of debt, approximate cost of debt, use the same formula, which is interest into 1 minus t, but we are ignoring tax for the time being. So that's going to be 12 as the interest plus redemption value of 120 minus 100 divided by 2, the whole thing upon 120 plus 100 by 2. This is 12 plus 10 divided by 110. We get the approximate cost to be equal to 20%. Now, how to get the exact thing? For that, we'll have to compute the IRR. So we'll write down the year, the cash flows, the PV factor, and then the present value. So we take year 1 to 2, and the second year being the redemption value. So cash flows are going to be in the first 2 years. Cash flows is going to be 12 each year, and in the second year, the redemption is happening at 120. Right? We want the present value factor at, since the approximate rate was 20%. Let me just take it as 20% itself. And let's get the PV factors. 1 divided by 1.2. Use the GT function, we get the PV factor as 1.5278. And then 1 divided by 1. This is the PV factor, which is 69. Okay. We get the PV factors from year 1 to 2 as 1.5278, and in year 2 it will be 0.6944. Now PV factors, we have got it. We get the present value of the cash flow. So we get the present value of cash flow as 12 multiplied by 1.5278 is 18.33. Then 120 multiplied by 0.6944, which is 83.3. Take a total of both 18.33 plus 83.3. That is 101 point. What would be the value right now? Because we are going to issue this at 100. It means 101.66. If you take it as 100, there is a gap of 1.66 positive gap. I'm getting the present value at 101.66. Instead, it should have been 100. Right? How PV factor is computed? This is computed in your calculator 1 divided by 1.2. Or I can say 1 divided by 1.2. Do it equal to twice and then press the GT function. Grand total function. PV factor 1.5278 is basically 1 divided by 1.2 plus 1 divided by 1.2 square. PV factors are the basically value of 1 rupee that you're going to receive today. Value 1 rupee that you're going to receive in future. You take a total of it. Like you're going to receive 12 two times. So the total of two PV factors is okay. So we get the PV as 1.66. It means exact 20% is not our cost. 20%, exact 20% is not our cost. Rather, it will something different. So at 20%, we get 1.66 as a surplus thing. So we are going to reduce it. So let us compute the PV factor at 18% maybe, and then we take the PV. Right. So if we take the PV factor at 18%, so that's 1 divided by 1.18. This is 0.7182. That works out to 1.5657. Then you take the PV, which is cash flow multiplied by 1.5657 is 18.78, and 120 multiplied by 0.7182 is 86.1. Take a total. The PV that we get right now is 18.78 plus 86.18 is 104.96. So what we observe that if I am discounting it at 20% and get 1.66 surplus, at 18% I'm getting a surplus of 4.9. Suppose I need to make this number below 100. So if I decrease from 20 to 18, the difference widens. I need to reduce it. So therefore, we'll take instead of, because we observe that when we take 18% as a discounting rate, we're not getting the value as 100. Rather, it is going above 101.60. We want the value to be nearer to 100. So we are going to discount this at, let's say, at 22%. If we do it at 22%, 1 divided by 1.22. For the second year, the PV factor is 0.6719. And this is 1.4916. Then if you're going to multiply them, that's 12 multiplied by 1.4916, 17.89, and this is 120.719, 80.63. Now if we take a total, this works out to be 98.5. So based on this, we have got the rate low as well as high. So at a lower rate of 20%, and we have a higher rate of 22%. What NPV do we get? At lower rate, we are getting 1.66, and at higher rate, just compare it with 100, we get a NPV of negative 1.48. Now, we just have to apply this same formula for IRR. Then for IRR, the formula remains the same. It is row rate plus the NPV at lower value upon NPV at higher value minus NPV at lower value minus NPV at higher value into difference between the high rate and the low rate. Can we compute these numbers quickly? Lower rate is 20% plus NPV of 1.66, the whole upon 1.66 minus of minus 1.48 into the difference between the rate, which is 22% and 20%. What is this number, guys, by the way? 1.66 divided by so you get it as 21.057% as the IRR. Got it? Bhumika, did we get this concept, Bhumika? Yes? Okay. So in that case, let's take a break right now, right? A break of 5 minutes. What that will do, take up certain questions which I've already uploaded on the portal. There are two questions which are going to cover in our today's class. Let's take a break, guys. Break of just 5 minutes. Yes, let's take it forward. Cost of capital chapter. Uh, yep, we've done the concepts. Now we are going to look for the questions based on that. So we have this first question to discuss right now. This is a question from the past RTP and ideal question cover all the concepts. One go. So I'm just picking up this question. Let's first discuss this question and then go for its solution. Okay. Now, Auto Limited has the following capital structure as on 31st December 2023. It's considered to be optimum. 12% debentures, which is for 4,50,000. 10% preference share capital amounting 1,50,000. And equity share capital of 24 lakh. They have got 2 lakh shares. Of course, from this we can say what is the face value of each of these shares? What's the face value of each of these shares? 2 lakh shares and 24 lakh is the value. So the face value of each of those shares is 20 rupees, right? Yeah. The company's share has a current market price of 30.25 per share. Expected dividend per share in next year is 50% of 2023 EPS. Company's share price has got a current value of 30.25. Expected dividend in next year is 50% of 2023 EPS. Okay. So 2023 EPS is 3.023. 50% of that is going to be the dividend for the next year. EPS of last 10 years is as follows. The past trends are expected to continue. Now, tell me what is the trend that you observe over here. Can you tell me what's a typical growth in dividend that is happening over here? The amount of growth that is happening in this. Anyone? Can you tell me what's the growth rate in the dividends? Yep. What's the growth rate? Percent. Rate 11%, everyone. Then observe the growth rate of 11%. Just try if it is looking for each of the year, growth rate 11%. If you go 1.18, that you add 11% growth rate. Like in 2014, the EPS was 1.18. That if you add 1.1, that's 1.31. Basically, what you need to do get the growth rate is uh, 1.311 divided by 1.18. Divide that, say 1.311 is the current year dividend minus 1.18 divided by 1.18. 1.311 minus That's 11.10% for the first year. Then for the second year, thing is to consider 1.456 minus 1.311 and divided by 1.311. That's again 11.06. Approximately the growth rate is working out to be 11% by mere observation, right? Now let's see what all is there in the question for us to treasure. So the company can issue 14% new debentures and 12% new preference shares. Company's debenture is currently selling at 99. Current market price of the debenture is given as 99. The new preference issue can be sold at a net price of 9.9, paying a dividend of 1.25 per share. Company's marginal tax rate is TBC. So the new preference issue can be sold for a price of 9.9. 10% preference share that they are given. Those preference shares they're saying can be sold for 9.9 and paying a dividend of 1.25. So we know the amount of preference shares, we know the amount of net proceeds that you can get from the sale of the preference shares, and the company's tax rate is given as 50. Let us see what all things are we supposed to be computing one by one. First part is we have to compute the after-tax cost of new debts and new preference share capital. Calculate the after-tax cost of new debt and new preference share capital. And also we need to get the cost of ordinary equity, assuming new equity shares comes from the retained earnings. Basically, the cost of retained earnings is what they are expecting us to calculate. Let's go ahead with the first part. Yeah. Cost of new debt. Now the question specifies at what rate we can issue the new debentures, but they didn't specify what is the time period for which the debentures are issued. So in that case, our assumption is going to be that the debentures are irredeemable. Cost of new debt, we can compute it as equal to interest into 1 minus T upon net proceeds. Now in this case, we know that the debentures can be issued with the interest rate of 14% and the tax rate is 50%. We'll say interest is 14 into 1 minus 0.5, which is the tax rate, divided by net proceeds of 99. That's going to give us a cost of new debt as 7.07. The question also asks us to compute the cost of new preference shares. Cost of new preference shares. Cost of new preference shares will be simply the preference dividend. As we know, preference dividend don't have any sort of tax benefit. So preference dividend upon net proceeds. Preference dividend they have given in the question. Preference dividend is going to be 1.25 new shares, and each share can be issued for a price of 9. Preference dividend is 1.25 upon 9.9. 1.25 divided by 9.9, that is 12.63% as the cost of new preference. Then the question also asks us to compute the cost of equity shares, or we want the cost of retained earnings specifically. Now to get the cost of retained earnings, we know it is same as cost of equity. Now to get the cost of equity, the formula that we are going to use is expected dividend in the next year upon P0, which is the current market price. To that, we are going to add the growth rate. the expected dividend upon current market price plus the growth. So question has given clearly what is the expected dividend, because they are saying that the expected dividend per share in the next year is 50% of 2023 earnings. We can say it is 50% of 3.023 divided by current market price of the share. That's also stated in the question, which is 30.25. 30.25 plus. We need to get the growth rate. Now for growth rate, just do a small working note that will say year and the growth rate. Like in year 2015, growth rate is basically 1.311 minus 1.18, because of growth, the dividend in year 2015 is 1.311 and the dividend in 2014 was 1.18. So we want to know what's the growth rate that has happened in 2015. Is divided by 1.18. 1.311 minus 1.18 divided by 1.18 minus 1 divided by 1. That works out to 11.10%. Consider 2016. Then you have this as 1.456 minus 1.311 upon 1.311. 1.456 minus 1.311 divided by 1.311. This is again 11.06%. If you consider 2017, that's 1.616 minus 1.456 upon 1.456. This also comes out to be 11%. So looking at this, we can say that approximate growth rate is 11%, and therefore here the growth rate we are going to take is 11%, which is 0.1. Okay, so that works out to be 3.023. 50% is 1.511 on 30.25 plus 0.11. 1.5115, that's the expected dividend. 30.25 is the price. And that you add 11%. So cost of retained earnings or cost of equity of today 16%. Okay, that's the first part of the question. Let's go for the next part. The second part. It says calculate the marginal cost of capital for the new funds raised. So the new funds that we are going to raise, of course, those funds are also going to be in this proportion only. The funds that we are going to raise are going to be in the same proportion, because of the important word over here. It says that the capital structure is optimum. That the capital structure is optimum. I'm not going to alter this proportion of debt, equity, and the preference. I'm not going to alter this proportion of debt, equity, and preference share. So any new capital that I raise supposed to be in this same pattern. It is not in this same weightage, then the capital structure will get altered and it no more remains as the optimum capital structure. Okay, so the new capital has to be raised in this weightage itself. So let us say source of capital, which is first up debentures. Then you have preference share capital and equity share capital. We are going to raise them in the same weightage. If you compute the weightage of 4,50,000 on 24 lakh, that same weightage is going to be for any new capital that you're going to raise. 450 divided by 4, that's weightage is so this is working out to how much? 450 divided by weightage is 0.875. Then preference share is 150 divided by 2,400. That's 0.187. Then preference shares we have got a weightage of 150 divided by 2,400, which is 0.0625. And the equity shareholders are supposed to be put the balancing thing. Consider the total, right? The total of all of them, just write down the amount and take a total. It's 4,50,000, 1,50,000, and 24 lakh. If we take a total of all of them, that works out to be 24 plus 30 lakh. Now the weightage we can say, yeah, weightage is 450 divided by this 0.15, then 150 on 50 lakh, weightage is 0.05, and 24 on 30 is 0.80. So total weightage works out to be 1. Okay. Then we take the value of cost. We have already computed the cost of debt, cost of preference, and cost of equity. Cost of debt is 7.07%. Preference shares are going to cost us 12.63. And equity share capital are having a cost of 16%. Then we just need to take a weighted average. Okay. Right. Once we take the weighted average, so this works out to be like 0.15 into 7.27. That's 1.0605%. Then 12.63 into 0.05 is 0.6315%. And then we have 0.8 into is 12.80, 0.065 plus 0.6315 plus 12.8. We have this as 14.492% as the marginal cost of capital. The additional capital that we are going to raise is 14.49. That's going to cost us 14.492, provided we are going to raise them in this weightage. And rather, we have to raise the money in this weightage itself because they have stated that the capital structure is optimal. Okay, that's the second part. Then the third part, how much can be spent for capital investment before new ordinary shares must be sold? Marginal cost of capital remains to be constant. We are saying marginal cost of capital remains to be constant, assuming that retained earnings available for next year investment is 50% of 2023 earnings. So let us first compute what is the amount of retained earnings available. Retained earnings which are available That is 50% of the 2023 earnings. Now, 2023 earnings are EPS is 3.023. EPS is 3.023 into 50%. So per share basis, we have this much in our retained earnings into the number of shares that are outstanding is 2 lakh. We just simply multiply it by 2 lakh and we get what is the amount of retained earnings that we are having 3.023 50% into 2 lakh. The money that we have is 3,02,300. This is the amount of retained earnings that we now understand what's the question requires us to calculate. It says how much can be spent for capital investment before new ordinary shares must be sold. Now, if I ask you, so this retained earnings, where is it going to get accumulated next year? Whatever is retained, of course, that gets accumulated in the equity, right? So the equity share capital which we have 24 lakh, that's going to get increased by 3,02,300. And the equity share capital is basically 80% of the total capital employed, right? Of the total capital employed, you observe that equity share capital is 80%, right? So if I have got this retained earnings available for next year I'm not going to issue any shares. But since this is our optimum capital structure, I need to maintain this ratio. Now to maintain this ratio, this is going to club with equity shareholder. The equity share value is going to increase by 3,02,000. And if I don't increase simultaneously the debenture and preference shares, the weightage is going to get disturbed and proportion is going to get disturbed. And for that reason, I need to get some more amount of borrowings and preference share capital so that the capital structure ratio is maintained, right? So we say amount of debt to be issued. Amount of debt to be issued. How much debt are we supposed to issue? So 3,02,300 has got a weightage of 0.18 and debt has got a weightage of 0.15. So we need to issue an additional debt of 3,02,300 divided by 0.15, which is 56,081.25. This is the amount of additional debt that I need to issue. And similarly, I need to issue some amount of preference share to keep the capital structure constant. The amount of preference share capital to be issued is 3,02,300 for 80%. So for tell me 55%, how much should I be issuing? That's 18,893.75. So total addition to capital will be, of course, retained earnings of 3,02,300 plus 56,681.25 of debenture holders plus 18,893.75 of preference share capital. That total will be 3,77,875. 3,77,875 will be the addition that will happen to the capital, and that's the investment which you can make without issuing any equity. If you want amount more than 377,875, you will have to issue additional equity share. Because whatever amount of retained earnings you have, that will make total of capital as 377 if you are going to borrow preference share and equity, preference share and debentures. Rather, you are definitely going to borrow money and and raise money through preference shares to keep this capital structure or the proportion constant. Because question has stated that it needs to be optimum. Now, whatever is optimum, we are not supposed to be, changing that, right? Whatever things are optimum, just don't change it. Keep it as they are, right? So therefore, we say total addition to the capital or money which you can spend without Adding without any additional equity shares is 377, 875. Okay, are we clear till here? Okay, let's go for the next question in it. What will be the marginal cost of capital if the company can sell new ordinary shares of 22 per share, assuming both cost of debt and preference shares are going to remain constant? Of course, if the share price is changing, the cost of equity is also going to change. So we need to get the revised cost of equity. The revised cost of equity is E1 upon P0 plus G. D1 is going to remain same what we have calculated as 1.5115. But the current market price, the question says is 22. Or you can say you're going to issue this you're going to issue this at the price of 22. We consider P0 as 22, and that gives us a revised cost of equity as 17.87%. Okay. That's going to give us 17.87%. And now if I want to calculate the marginal cost of capital, you have debentures, you have preference share capital, you have equity share. Now, debentures are having a weightage of 0.15, preference share having a weightage of 0.05, and equity shares are having a weightage of 0.8. The cost is for debenture it was 7.07. For preference shares it was 12.63, which we have already computed earlier because the question says that other costs are going to remain same. Then equity shares have got new cost as 17.87. Okay, so we've got the weightage, we have got the costs. We just have to take the weighted average. So it is 0.15 into 7.07 is 1.06%, 12.63 to 0.05 is 0.63, 17.87, 0.8 is 8.96, 1.26 plus 0.3. That gives the answer as 15.986. That's the new weighted average cost of capital. Okay. Now it's time for any Q&A session. Students can unmute themselves and ask for any queries or doubts that you have got. I'll share this file. Preeti, I will share this file on the portal itself. I'll share this as well as solution of ratio analysis and solution of one more question of cost of capital. In fact, this solution is there on the our module. Info is from the module, the last question. You can just that. You should find it. Okay. Any queries that you would like to ask, guys? You can just unmute yourself. Just raise your hand. Most of ratio analysis is blank. Yeah, that's it's not blank. I have left the space in there because that's the file on which I had worked. The updated file along with the solution I'll be uploading. You will find just the name of the ratios in the file, but that will get updated. I'll upload a revised file for that solution file. Any queries about cost of capital gain, concept that you are struggling with, or anything, clarity, any question you want me to solve for you, please feel the happy to answer your queries, and also any specific question that you want me to solve for you quickly. You can do that. No queries? Okay. In case there are no queries, let me do one thing. Let me solve this question 2 for you right now. Question number 2. 15% convertible debentures of rupees 100 each at par with a maturity period of 6 years. So we get interest as rupees 15. Maturity period N is 6 years. On maturity, each debenture will be converted into 2 equity shares of the company. On maturity, each debenture will be converted to 2 equity shares. So now, here's the trick. This debenture is not going to redeem for cash, but rather that's going to be redeemed for equity shares. And they say the risk-free rate of return is 10%. Market risk premium is 18%. So we have another dimension of data given to us right now. We have the risk-free rate as 10%. And market risk premium, which is RM minus RF, is 18%. Beta of the company is 1.25. Company has paid dividend 12.76 per share. Company has paid dividend 12.76 per share 5 years ago. It paid a dividend of 10 per share. Okay. We have dividend currently as 12.76 and dividend 5 years before. Dividend 5 years earlier was 10. So this was 12.76. And flotation cost is 5% of the issue amount. So right now over here, we need to first get the value of equity share, because see, this debenture is going to be redeemed for equity shares. Now, if it is going to be redeemed for equity shares, of course, the value of the shares is something relevant for determining the redemption value. Because you're not going to get cash out of redemption, you're going to receive shares. If you're going to receive shares, after 6 years, I need to get the value of the share after 6 years. For that, I need to get the growth rate. So D0 will be actually D minus 5, which is the dividend paid in 5 years before, into 1 plus growth rate raised to 5. So this means 12.76 will be 10 into 1 plus growth rate raised to 5. That will be 1.276 equal to 1 plus growth. Therefore, 1 plus growth raised to 5. And if you solve this and check for the growth rate by trial and error method, you will find that growth rate is essentially 5%. Once we have the growth rate as 5%, we are really interested in redemption value. Redemption value will be the value of the shares after 6 years. As we know, it was K equal to E1 upon P0 plus G. If you rearrange it, get it as P0 equal to E1 upon KE minus. So same way, if I want price in year 6, I'll have to take dividend in year 7 upon KE minus growth. So dividend in year 7 will be 12.76 into 1 plus growth rate of 5%, 1.05. That will be raised to 7 because 12.76 is the last year. That's the dividend that we have paid recently. And we want to know the dividend after 7 years because the redemption is going to be in the 6th year and run the value in year 6. So this divided by KE minus G. So cost of equity is something that we need to compute over here. That we can get it as simply RF plus beta into RM minus RF. So RF is 10% plus 1.25 into 18% being the market risk premium. That will be 18 into 1.25 plus 10, which is working out to be 32.5% is our cost of equity. Cost of equity is 32.5. Let me consider 0.325 minus growth rate of 5%. Price that we receive as the price of the share, which is likely to be prevailing after 6 years, that's 65.28. So redemption value will work out to be what? 65.28. You multiply it by 2. 65.28 you multiply it by 2. Why 2? Because you are going to redeem this debenture for 2 equity shares. So the redemption value is 130.5. And net proceeds in this case, as the question says, flotation cost is 5% of the issue amount. So of course, we say we might be issuing this at face value. On that, you are going to reduce 5%. So net proceeds is basically 95. We have interest, we have redemption value, we have the net proceeds, we have the tax rate also. Yes, the tax rate is assumed to be 40%. Now we are in a good position to compute the cost of debt, and that too using approximation. We can apply the approximation method formula. Cost of debt equal to interest into 1 minus t plus redemption value minus net proceeds upon n, the whole divided by redemption value plus net proceeds by 2. That's equal to interest t into 1 minus tax rate of 0.4 plus redemption value of 130.56 minus net proceeds of 95 divided by 6. Then we take an average of 130.56 plus 95 by 2. Solve it. And we should be getting the answer as 13.24%. That's the cost of it. This was a new type of question wherein the redemption is happening in terms of shares and not in terms of cash. और इंटरेस्ट रेट कैसे फाइंड आउट किया? इंटरेस्ट रेट किसका बोलते हैं? 2 का इंटरेस्ट रेट 15% convertible debentures is given, right? 15% convertible debentures. 15% is basically 15 rupees of a face value of 100. Fine. Okay, fine. So now again, this preference shares you have to solve it by using the IRR method. We have already done a couple of questions in our today's class. You can refer that. Yes, if you have any query, I'm just putting up again. And just pick up the query, or you can unmute yourself, raise your hand. I can unmute you, and then I will listen to your query and answer it accordingly. Vani, Venkatesh, Yugandhar, Manish, T, Ka, Jayalakshmi, you all good? Pranjali, Sweetie, all clear? Clear. Okay, yes. Fine. Then in that case, let's call it a day right now. Let's just stop here, right? So just revise the questions. You can just go through the module and RTP, MTP questions. If you have any queries, you can definitely come up with those queries even in the next lecture. I'll be happy to help you out. Let's just stop here then, guys. All the best. Good night. Take care.
Okay, sir.
Azhar.
Okay.